That's a bit of Mark Knopfler on the screen there, going home or coming home. I'm going to call it coming home because it feels like we're coming home, the oil and gas industry. For those that you are as old as me, you remember 2007 and 2008 and 2010 when we held the good oil down at Fremantle. And at the time, it was the biggest show that we used to do. It was a fantastic, really big show. But sadly, the oil and gas industry has dwindled a bit over the past time. And then 2 years ago, of course, nothing with COVID and zero price oil. But I feel as though we're making a comeback. And I think we've got the EV market to thank for that. Because I think it's all about EV at the moment and ESG and everything like that. And the world's so fascinated with this electric world that they forget that all these things that they need to dig it out of the ground, they need oil and gas and coal. And that won't change in our lifetime. Well, certainly not mine, I don't think. I could be wrong, but I think we'll still need oil and gas and coal for a long, long time. Thank you and welcome to the Good Oil Conference 2022. My name's Stewart McDonald. On behalf of my partner, Simon Hadfield from RIU, we welcome you. My job today is just to talk for about 2 minutes and fill in a bit of time until I hand you over to Peter Strachan, who will give you a little overview from where we were last year. Now, Peter's the MC for the first session, but don't panic. Chrissy will be back for the after lunch and she'll be here all day tomorrow. So you've only got Peter for a session until Peter closes out tomorrow afternoon after he's heard the whole conference. Many thanks to our sponsors, Argonaut, of course. They're giving their address a bit later tonight and then into drinks. RISC, thank you for RISC, giving the next speech after me. They've been here for many, many, many years. Our insurance sponsor and barista sponsor, Gallagher's. And of course, we have the Lynn partners and all the supporters. Thank you also to overseas people who have made it here. I see we have friends here from South Africa, friends here from Timor, and Canada. So it's very nice to have these people who are actually in the room today. To all of you watching online, all over Australia, all over the world, wherever you may be, welcome also. Sit back and have a look at the Good Oil and Gas Conference, and hopefully we can make an investment or two to add to your ever-burgeoning EV portfolio, but this one may actually make you money. So that's all from me. Thank you to everybody. Hand over to Peter Strachan. All yours, Pete.
Yes. We're going to have the... I think we're having a welcome to country. Talk amongst yourselves. Yeah. Okay. Okay. Well, thanks for coming today to the Good Oil, and I'll be doing a wrap up tomorrow, and a number of things that Stewie were talking about. We'll be touching on just what's changed in the industry, certainly over the last 12 months. I mean, when you look back to last September, it's really difficult to comprehend the sort of changes that we've seen with Putin invading Ukraine, price of energy in Europe going up tenfold. Putin, I think, is going to try and freeze Western Europe during the coming winter, freeze them into submission. And he's got his social media and his various operatives in Western Europe trying to stir up, foment problems. Those people who stand against him end up trying to learn to fly from a 5-story window, or they find their stomach full of Novichok. But if you look back over the last 12 months, oil price has risen from sort of $72 to 96 as it is today. Woodside price was $19.50 when we gathered last September. Today it's about $36, $35 and a bit. Henry Hub gas was $4.30. It's recently been over $9, currently about $8.30 or something. Coal prices of I said last year was oil going to have a coal moment, because we were used to having thermal coal at between sort of $55 and $100 a tonne, and now we've got thermal coal at sort of $366 a tonne. And the coking coal people are actually selling their product to power plants because the coking coal price is less than that. Copper price is pretty much the same. Well, actually, fallen $1. It was $4.30, currently $3.40. And liquefied natural gas on contract was about $18.60, and it's currently $55 a gigajoule. And in Europe, European gas price was about $13.13 a gigajoule. And when I looked yesterday, it was about $60 a gigajoule, but it had been $93 a gigajoule. And the price is so volatile, it's hard to keep up with where it's going. But if we take a longer term view, energy consumption in Australia has doubled basically since 1979. So in the last 43 years, energy consumption in Australia has doubled, and the population of Australia has gone up by about 75%. So I think it was around 15 million. It'll be 26 million in about a month or so. So the difference in the emissions that we've had out of Australia, the emissions, of course, gone up pretty much in line with population growth, and that's been added to. The use of energy has been added to over and above the rise in population by the increase in affluence in the society. So people get wealthier, they buy an extra car. I mean, it's, I was saying rich people want a bigger car and poor people want a car. So there's no end in sight for people wanting energy. And I think if you're around for my talk tomorrow, I'll be showing how in sort of counterintuitively, the actual amount of drilling that's been going on in Australia, certainly since about 2009, has been falling. And the number of drilling rigs operating globally, I showed last year the drilling rigs in the United States and also in Saudi Arabia, had actually fallen. There's been some sort of a pickup sort of in the last 12 months, but we're still way below the levels we were seeing a decade ago. And so really the situation we have now with Putin and what that's done to gas prices, not only in Europe, but in Asia as well, has been remarkable. And it just shows how much we are skating on thin ice. And that's really the title of my presentation tomorrow afternoon, is skating on thin ice. It doesn't take very much, sort of the butterfly flipping its wings somewhere in central China, and all of a sudden there's a cyclone in the Gulf of Mexico. And that's basically where we are now, with sort of 8 billion people trudging around on the planet. So with that, I'll welcome you all here, and we'll move into our opening address. And our first address today is from Martin Wilkes, who's the Managing Director of RISC. Now, RISC, as many people will know, is a leading independent international advisory company, but many people may not know that Martin is both a chartered engineer and an environmentalist. He is a fellow of the Institution of Chemical Engineers, and since joining RISC in 2010, he's provided advice to clients on hundreds of projects over 30% of the world's liquefied natural gas projects. So that's certainly a good place to be. Can we welcome Martin to the podium?
Thanks, Peter, and thanks everybody for having me back. I think this is my 15th Good Oil, and I must have spoken at least a dozen of them. Before I start, I'd just like to also acknowledge the traditional custodians of the land, the Whadjuk people, and pay my respects to their elders past, present and emerging. I haven't got very many slides, but I like to talk. So you'll see as we go through that there's quite a lot to talk about on these slides. First one, this is probably the only disclaimer you're going to be able to read in the whole 2 days. So take your time. And whilst you're talking about that or reading it, I'll tell you a little bit about RISC. So yes, we're an independent advisory company, and I'd like to stress the independence. I'm also not asking you to invest in us. You can't. We're an independent, privately held company. Our role in the industry is to help our clients, most of whom you will hear, or you'll hear from a lot of our clients later on today and tomorrow. I wish they were all our clients, not quite all, but a good percentage. And hopefully we'll get some good mentions as well as you go through the days. So our role is to give an independent opinion which allows our clients the confidence they need to make their business decisions. We help operators, non-operators, financiers, investors, boards, really anyone who wants to invest and spend money in the oil and gas industry. I think we can help you. And I hope you'll understand a bit more about that as we go through this talk and through the next few days. As Peter said, thank you for the plug, Peter. I am a chartered environmentalist as well. I've been a chartered environmentalist for about 20 years, and it's only really in the last 3 that it's actually been relevant or people have thought it's an interesting qualification to have. So I have some green tendencies. I'm not an activist, as you'll see from this, but I am a pragmatist. And so in answering that question, can we have energy security and emissions reduction? I think I've got some good points to make. Okay, so let's start with what we all know, that we're moving to a lower emissions world. Lots of reasons for that. Net zero 2050 is the phrase of the moment. And I've got some graphs on here. I'll just point you to the dotted line first, because that's what's happening in the world. This is a graph of energy intensity, by the way, not absolute emissions. But you see people are making an attempt to reduce their emissions. I'm going to talk about power generation in particular here, because it's easy to, and it's a fairly concise subject. And if I was trying to cover all emissions, I think we'd be here for about 2 days. Next one I want to talk about is the one at the bottom, which is France. France relies heavily on nuclear power, and that's why it's got a very low emissions intensity for its power generation. If you look at the 2 other top ones, you'll see Australia at the top and the US in the lighter blue. Whoops, sorry, I'm pressing the wrong buttons here. It's always a good start, isn't it? So Australia here and the US here. And you see we're actually following a fairly similar trajectory to the US. The reason we're above the US there is purely down to nuclear. About 20 years ago, Australia became a nuclear-free state. I don't see that changing in the near term, or in fact, even in the longer term. So that means we're just going to have to work harder to reduce emissions more. The last one I want to talk about is this one, which is the UK. And you see the UK is on a different trajectory to where the US and Australia have been. And that's basically because the UK has cut its reliance on coal. As of last year, no, it's gone too far. As of last year, I think the UK went 2 months coal-free, or it might have been 2020 they did that. But overall, their reliance on coal is less than 2% now. By contrast, our reliance is about 50% over the whole of Australia. And now this is a graph. I've shown this graph in various guises for about the last 5 years, and I'm not going to make any apologies for that because I think it's still very relevant. What I'm going to focus on is these 2 bars down here. So the graph basically says if you can take coal out of the mix, you'll see a significant drop in emissions. The replacement here is with variable renewables, and you see gas gradually increasing as well. Once you get to a point where you've basically saturated the market with variable renewables, and by that I mean you have enough variable renewables to make up 100% of your demand for any one point in time, that's where you get your biggest bang for your buck. Beyond that, if you add in variable renewables, you're basically asking them to turn on and off when they really want to be on all the time. And you still can't avoid having something to back them up. And that's my premise at the moment, is that we don't really have anything else apart from gas to back up renewables. So keeping gas in the mix is a good idea. If you don't keep gas in the mix and you keep coal in the mix, you actually don't do much in terms of emissions reduction. The reason for that is, if you think about your gas barbecue versus charcoal barbecuing, which is what I grew up with as a kid, you'll know that your gas barbecue, you can turn on the valve, light it, cook. Within 20 minutes, it's all cooked. You turn it off again. You try doing that with a charcoal barbecue. It's the same with power stations. Gas-fired power stations turn on and off easily. Coal-fired power stations don't. So I mentioned the UK. That's the one I wanted to concentrate on. And you'll see here, this is their absolute emissions from power generation. And in 2010, it was about 150 megatons. And it's dropped to about 50 now. So they've had a reduction of about 65%. And in that time, they have reduced coal, that's these dark blue bars here, down to about 1 or 2% of the energy mix. They're in a bit of a strange position now here, because I believe they have reached that saturation point with variable renewables. And so two things have happened in the UK recently. The growth of renewables has slowed dramatically. So last year, they only had 3% growth, which was about half of what they had 2 or 3 years ago. But moreover than that, that growth didn't actually cause any increase in actual generation from renewables. And that was because it didn't blow as hard and the sun didn't shine as much. So there was actually less renewable power generated in the UK in 21 than there was in 2020. And what happened? Well, they turned to gas use to replace it. So gas use increased by about 20% in 2021 versus 2020. Waiting to see what happens this year, because I think gas is probably going to go up even more. The other slightly amusing thing about the UK, of course, is that they banned fracking in 2019. And so to cater for that increase in gas use, they're importing gas from the US, which is basically all frack gas. Right. Okay, I mentioned Australia's emissions. We have actually reduced a little bit, so I think we should all be happy about that. Not as much as the UK, and Peter mentioned that, of course, we've had population increase. Just going back to the UK briefly, though, because their population now is twice as large as it was in the 1880s, and their emissions are about the same as they were in the 1880s. So it is possible. We just need to work harder. Of course, over this end of the pond, we're in a much better position than the eastern states. You'll see here, in fact, you probably can't read it, but this is New South Wales, Queensland and Victoria make the vast majority of our emissions. And that's where all the coal's burnt as well. WA, less so. We're about, I think we're about 60% gas here. And of course, Tasmania is actually 90 odd % renewables. It's hydro. So Tasmania is laughing at the rest of us. Makes a change. This doesn't seem to be clicking on. There we go. Just talking about another relevant experience here with South Australia, because they have also removed coal from their power generation mix. And you may have seen quite a lot of media attention that South Australia has also had moments where it's been 100% renewables. That's all great. But the reality of it is that they're still reliant on gas for about 40 odd % of their emissions of their power generation. And that's probably where they're going to stay, because that's roughly where the UK is as well. The impact of batteries, by the way, is that little line there below the 1.8 and above the 4.8%. So they installed the world's largest battery in 2018. It's still one of the top 4 or 5, but it doesn't actually provides storage capacity or dispatchable capacity. It provides firming and grid stability and what they call inertia. Another topic. Looking at it slightly differently, this is from the AMO site. You'll see this is from May. You can't read this bit. I apologize for that. May through to early July this year. And you'll see over that whole time, wind was providing about 50% of South Australia's generation and gas about 44%. Battery is 1%. What I actually wanted to show was the difference in where that supply is coming from at particular points in time. Where the black line is where these bars are. And you'll see from that even though they've got a heavy amount of renewables in their system, there are times when gas is supplying the vast majority of their power generation, 84% at this point. And then a few hours later, it was providing very little because the sun came out. That was basically where I wanted to leave it, is that we have a way of transitioning, and I believe that we don't need coal in a generation mix. We can get rid of that through a mixture of renewables and gas. But beyond that, I don't think we yet have a viable solution to get to net zero. It may come, but I think for the next 10 or 15 years, we should probably concentrate on what we know we can do, and that's getting coal out of the mix. Might mean that we probably, well, in fact, I think it does mean that we need to accept the fact that we might need to increase gas-fired power generation. And that's good news for most of the people in this room, I think. I'll leave you with that. Thank you very much.
Thank you, Martin. I think we've got time for a little bit of questions because Martin was very economical with his time. Are there any questions from the floor? So, Martin, what do you think is the, do you look at the energy return on energy invested in these different types of projects? Because, you know, we know that in the old days, you could invest a barrel of oil and get 100 back out of the ground. And nowadays with fracking and so forth, you might invest a barrel of oil there and get maybe 15 back. And there's been some numbers done on what the energy cost of building a wind turbine might be. And, you know, some people saying you get maybe 8 units of energy back for every unit of energy put in, which is hardly enough to, because modern society, you've got the legal system, you've got the judiciary, you've got the parliament, you've got schools and hospitals. None of those things which we rely on actually produce energy. They need energy, surplus energy. So, you know, what makes the economy go is surplus energy. Do you do any work on that?
Not specifically. I know where you're coming from. Obviously, as a chemical engineer, 2 things I learned. One, what goes in must come out unless it stays there. And the other one was all about energy efficiency. So I'm a big fan of energy efficiency. And some of what's happening at the moment flies in the face of that a bit.
Yeah.
I'm very open to a lot of what's going on. I think there are ways forward here. We don't know them all. I'm a big believer in making the steps that are obvious and easy first, and then working out what to do next.
We probably all need to go back and have a lesson in thermodynamics, because if you got some energy and you turn it into hydrogen, and you get
less back.
You get 25% of what you started with. You might as well use the energy you had. Yeah. Okay. Thanks, Martin. That's great. So our next speaker is Andrew Knox, and Andrew has a long career. He's been to this conference many times in the upstream oil and gas business and the resource sector, working extensively throughout Australia, Southeast Asia and North America. He's been involved in many acquisitions, stock exchange listings and fundings, multiple jurisdictions around the world, as well as exploration, development and operations, and has been a director of several public companies, predominantly in the oil and gas. And Andrew joined Red Sky in July of 2018. Thanks, Andrew.
Thank you, Peter. Good afternoon, everyone. I've got to say it's good to be back in my home state of Perth, particularly when you turn on a performance like you did last Saturday night. long may it continue, at least for another 3 weeks anyway. Usual disclaimer, I'll let you read that at your leisure. Corporate snapshot of the company. We've got a very experienced 3-man board and management team. Ticker codes ROG on the ASX. Got about 5.3 billion shares out. Equates to about a market cap of 32 million. No debt. And the top 20 have about 23% of the shares out. This is where our Australian assets are located. They're all in the state of South Australia. We have 6 contiguous licenses up in the northern Cooper of the state. We've got a 20% interest. Santos have the remaining 80%, and we're carried through a work program there. And now down in the Penola Trough in the southeast of the state, we've got 100% interest in the Killanoola oil field. And our head office is in Melbourne. So this has been the company's strategy. We've been looking to buy production or near-term production that we can add value to through working these up and moving them from resources to reserves. Using technical expertise, further exploration, 3D, infill drilling, with a view to then eventually developing or farming out to get these developed to monetize the assets. And that's what we've done so far within Aminka and Killanoola. So just focusing in on the Killanoola oil project, it's up here in the retention license, PRL 13, just north of the township of Penola in the Coonawarra, where we've got a regional office. This field was discovered back in '98 with the drilling of the Killanoola 1 well. It was muted to have 300 barrels of oil per day on test through 5 meters of pay. It's still got a pump, a linear rod pump in the well. And down in the SE1 was drilled in 2011 in the southeast of the license. That was also an oil discovery, this case, but has never produced. On the back of this, we commissioned a petrophysical analysis of these wells, where it was identified an additional potential 37 meters of pay in DW1 and 17 meters in SE1, the saltpit sandstone. So then we had another report done on the in-place volumes, taking into account this additional pay that's been identified in these 2 wells. I'm pleased to say this moved the best estimate of the in-place volumes from 7 up to 93 million barrels. And this in turn extrapolated out on a 2C basis, the contingent resources from the existing 2.8 up to nearly 28 million, nearly a 10-fold increase, which is very pleasing. And obviously the plan here is to try and monetize this asset. So how do we do that? We've been working very hard on a sales contract. This has been hampered by the fact that the crude is actually quite waxy. It's paraffinic, high pour point, but we think we're nearly there. We're working on the existing 5 meters of pay at DW1 to bring that into production, while we also look at perforating the additional zones of interest that have been identified. To that end, we need to mobilize a rig, which we're working on, and we've started to purchase topside equipment. To this, obviously, we're going to run cement bond logs, tubing conveyed perforations, and then install pumps, linear rod pumps at both sites. Because of the viscosity of the crude, we're going to heat it throughout the whole process. That also involves heating the tanks for delivery to get it to the end buyer. And then, of course, we'll also look to blend that with third-party crude as well to reduce the pour point before it goes into the buyer's system. So this is our solution for the wax. Heated all the way through the lines, heated tanks, even for the trucking. As mentioned, the crude has a high pour point, 36 degrees. But through the heating and the insulated tanks to get it to market. It'll keep it liquid, and we can also do this even during the winter months. So these are the tanks. We're having these built in Melbourne, in Yarraville. They're twin skinned. They're heated through hot water or steam. It can heat up quite a high temperature, more than we need. They hold about 24,000 litres, about 150 barrels each. 2 of those have already been delivered last week and more on order. And this enables us to, these can be put on trailers, which we're planning to do, and any prime mover can move them, which allows us flexibility. We had a production test last December where we managed to get samples out and get that assayed. I'm pleased to say it's pretty good quality crude. We've got an API of 36 and 65% of it's gas oil with some naphtha and kerosene as well. So turning our attention to the Inaminka assets, in the north of the state, in the Cooper Basin, we've got 3 fields there. The Yarrow gas field, which has 3 wells in it. The Flax oil field, which actually previously produced about 180,000 barrels till the oil prices collapsed, is fully developed, 6 wells in it. All the infrastructure is in place. And the Juniper oil field out to the southeast, and 3 exploration licenses further out. In 2019, late 2019, we farmed this out to Santos for a carry through a capped work program that involved 3D over Yarrow, a vertical well in Yarrow, a horizontal well in Flax, and a carry through the development program for Yarrow, which we have to repay out of production. On the back of reprocessed 2D, Santos determined a drilling site for the vertical well at Yarrow. We've been trying to drill this well since late last year, and constantly due to inclement weather, we've been able to get it drilled every time we went to drill it. I'm pleased to say I've just been advised that we actually the rig is mobilizing to site tomorrow, and we intend to spud it next week. So that's really really good news. Santos have also received approval to build a pipeline from Yarrow down to Napawi, 17 kilometers to the southwest, to tie it into the Santos grid to get it to market. So that's good. And post that, we'll be looking at what we're going to be doing at Flax, potentially tie that also into Yarrow. So this is a look at our inventory at Inaminka. We've got 3.6 million BOEs net to Red Sky on a 2C basis. This is from, on a gross basis, 20 BCF of gas at Yarrow, 10 million barrels at Flax, and 20 BCF of associated gas, and about 900,000 barrels at Juniper. So this is our project development schedule. Obviously, we've had the resources upgraded at Killanoola. It's low capex, and we're going to get that 5 meters of pay into production first, and we think we'll be in production next quarter. We've got drilling commencing late in the 3rd quarter at Yarrow, in fact, next week at Yarrow. And that'll be followed by 3D seismic, potentially over Yarrow, to work out where we're going to site the other development wells. And then again, for the full field development, will be tied into Napawi. Then post that, we'll be looking at Flax, what we do there. And also Killanoola, we shot 3D at Killanoola earlier this year across the whole license, retention license. We've had that processed, and we're in the throes of interpreting that, and that'll be used for the basis for the field development for Killanoola as well. And then we've got a watching brief on acquisitions. Constantly, oil prices remain strong. We've seen as the majors transition or diversify out of hydrocarbons into renewables. This has thrown up a lot of opportunities, which we've constantly got under constant review. Thank you for your time.
Thank you, Andrew. While you're there, will the horizontal well do the trick there at Flax? Because those, as I remember, the sediments are quite tight there. Is it, or you have natural fractures, or is there going to be some further stimulation?
We are actually reviewing that at the moment. If we actually do that horizontal well, so maybe do something else instead. So that is under review at the moment, exactly for that reason.
So suck it and see at this point. Yeah.
There won't be any, yes, that's right.
Okay.
Yeah.
Well, Andrew, thank you for your presentation today. And news flow is obviously going to be, it's happening as we speak virtually.
Yes,
so
yes, later this month, and
we're going to have from both projects.
Both projects, that's correct. Yeah.
And they're both fairly quick to market in a gas market over east, which is
wonderful.
Thank you, Mr. Putin, or whatever. Yeah. Okay. Well, thank you very much for coming, Andrew, today, and we'll look forward to watching the ASX for announcements as they come through over the next month or so.
Yeah. Thank you, Peter.
Thank you.
Thanks.
Our next speaker is Matthew Boyall, who's the Chief Executive Officer of Q Energy Resources, which is Andrew Knox's old stomping ground. He's been the Chief Executive Officer of Q since 2017, and prior to which he was Q's commercial manager. Matthew has over 20 years of experience in energy and natural resources companies, which include Schlumberger, WMC Resources, BHP, Nexus Energy, and has held positions offshore operations, procurement, strategy, marketing, M&A in Asia, USA, Australia. It's nowhere he hasn't worked, really. It's basically everything. And he has an MBA from the University of Melbourne, which is a good place to have an MBA from. And he is a graduate of the Australian Institute of Company Directors. Matthew, welcome to the podium.
Thank you, Peter. And thank you all. It's good to be back in Perth for Good Oil, coming from Melbourne. It's been a good 3 years since I've been able to come over here. I'd like to take you through Q Energy presentation today. And if I was a marketing person, I might change the heading and you might be seeing something like the new Q 2.0, because what I'm going to take you through is a scale change in Q in FY22 that's sustainable over the next short term. We'll go back, and this will be published on the ASX. I encourage you to take some time to read the disclaimers along with the presentation. So Q had a scale change in FY22. We had organic growth from our Mahato PSC in Indonesia, oil production, which we'll take you through, and we acquired interests in the Amadeus Basin assets previously owned by Central Petroleum. So we have high cash generating abilities at the moment, and we'll see that through our revenue last year. And it's likely to continue into next year as we have near-term development options at our existing assets. We'll see our portfolio is diverse with 7 projects, all contributing revenue over 4 geographic areas, a good mix of oil and gas. Market cap was about 47 million at the end of August. You'll see we have an EBITDAX multiple of 1.6, and you will see on the next slide that our revenue is slightly under our market cap, which is an interesting position. So in FY 2022, Q had $44.4 million of revenue. From that, $29 million EBITDAX, good cash generation. We had production of over 600 barrels of oil equivalent. High margin oil, and we recorded a profit of 16.1 million. All the green arrows there pointing upwards, showing the scale change during the year, and expect that to continue as a sustainable change for the company. As I said, we have 7 revenue producing assets in 4 geographic areas. We start from the bottom corner, the Maari Manaia fields in offshore New Zealand, oil production, FPSO shipped to the east coast of Australia. We've been in the field for a long time, and it keeps producing and still giving good results, especially at these oil prices. Our newest acquisition is in Central Australia there, the Mereenie, Palm Valley and Dingo wells, Dingo Fields, where Central Petroleum is the operator, and Q acquired between 7.5% and 15% of these fields in October 2021. We have two producing areas in Indonesia. The Sampang PSC is a gas production. It's been a long time project for Q, continuously gives good results. Gas into power plant in Indonesia, replacing coal, just as Martin pointed out, helping energy to get in the right sustainable way to Indonesia. And our newest project is the Mahato PSC, which contains a PB oil field, and I'll get into some detail about that later. This is our growth engine. In 18 months, it's gone from 0 to 5,500 barrels a day and will continue. Provides the bulk of Q's revenue last year and going into the near term as well. Good mix of gas and oil, 7 different independent production projects in 4 geographic regions. That drives us to our annual revenue last year of $44.4 million. As you can see from the chart, a significant change from the previous 5 years, driven by the organic growth and the acquisition of the Central Australian assets. Indonesia contributed the most there, $27 million. Up Mahato itself, our PB field is 15 million, up from 2 million the year before. And the chart there shows indicative growth in the near term, and that's revenue growth that's going to come from wells that are already planned in Indonesia, wells that are already planned and happening in Central Australia. We again also see the support for the oil and gas prices that will help us with this sustained revenue. Revenue comes from the barrels we produce. We produced over 600,000 barrels of oil equivalent last year, up 60% from the year before. And the growth expected to continue as we drill more wells in both Indonesia and Central Australia. Indonesia was the largest area for production geographically, and 65% of our production came from gas. So that's Q in a nutshell, our PB field, where we've got producing wells in the front and a rig continuously drilling in the background there. This is our growth engine for Q. Now, the Mahato PSC is in central Sumatra, stone's throw from Minasanduri billion-barrel fields. The PB field was discovered about 2 years ago by our exploration wells and now contributes $15 million a year to Q last year. It's a large resource. We recorded at 93 million barrels of oil in place, 21 odd million gross recoverable. And there are nearby fields that do get higher recoverable rates than that over their 30 to 40 year lifespans. The map we're seeing there shows 10 wells in green, which are the wells already drilled, and they contributed to our revenue last year. And that's about 5,500 barrels a day field production. And the growth story is the pink dots. That's 10 more wells that we've got approval for, that are the rigs in place. We've already started drilling, and these will be drilled next year. As you can see, the field, we're moving north, and the dots move north while we gather the extent of the field. So the northern boundary of the schematic is still slightly unknown as we look forward to moving north with the wells. And as we move forward and drill wells at a rate of 1 a month, and the first 2 wells were drilled in June and July of this campaign, came in at 1,000 barrels a day and 800 barrels a day. And we're going to drill one well a month for the next 10 months. I'm currently drilling PB 21, the next well. It's into the same reservoir, well known now. There's almost a dozen holes in it. We know what we can expect. And what we can expect is shown in that schematic there. Within 12 months, we'll have drilled 10 wells and have the potential to double the oil production coming out of the PB field. The wells are 5,000 to 7,000 feet, go from spud to production in a month, get Brent price, are connected to existing production, existing transport. This is the growth of Q in the near term. Also in Indonesia, our Sampang PSC. That's a picture of our Grati gas plant, which processes Sampang gas into Indonesian power. Another growth area. So the current fields, Oyong Wortel, gave us $12 million of revenue last year from long-term gas contracts, very predictable long-term gas. The growth here is at Paus Biru gas development. Now, Paus Biru was a gas discovery a couple of years ago. FID is expected in the coming months. It's been slightly delayed through Indonesian approvals and COVID getting in the way. It's a simple, single wellhead platform to the existing Oyong infrastructure and export infrastructure. Expect first gas by 2025 at a rate of 20 to 25 million a day. FID expected soon, on the tail end of getting approvals there. In Central Australia, currently drilling PV12 in the Palm Valley field in the Amadeus Basin. So we bought into the Amadeus Basin through Central Petroleum, which completed in October 2021. Brought in $8 million of revenue for those 3 quarters of last year. So expect full 4 quarters of revenue into FY 2023. Fields are connected to the East Coast grid. You'll see the pipeline connections there. We were able to sell contract, and we have contracted gas and spot gas, able to take advantage of the high prices earlier in the year. And there's also market price for condensate that comes out of Mereenie field. The growth opportunities here are right upon us as well. We're currently drilling the PV12 well in Palm Valley, which we'll talk about a bit more in a second. There's 6 Mereenie recompletions to be undertaken in the next 6 months, and 2 more development wells at Mereenie that are being planned by the joint venture. So 2 more development wells and 6 recompletions to add to the Mereenie production of gas to get more supply to the East Coast markets, which are, as we've heard and we'll keep hearing, strong demand and expected to continue. We're currently drilling the PV12 well in Palm Valley. It's been drilling since April this year, and the original target was a deep exploration target in the Arambera sandstone. The drilling got pretty hard, and we had to cease drilling the vertical section of the well. Just weren't getting anywhere. We changed the program to have a horizontal a lateral into the Pakuta P2, P3 sandstones there. Again, not very successful. We encountered water, so have pulled back and plugged that. And as of yesterday, or this morning announcement, we've now started drilling into the Pakuta P1, the lateral. Now the P1 is a producing field in the Palm Valley area. So there's hopes that that will be producing in this area as well. And it's all connected into the Palm Valley and Mereenie processing and pipeline infrastructure. So any gas will get to market very quickly. Murray has been in the Q portfolio for quite some time and continues to produce good revenue and good results, especially at the oil prices we're seeing at the moment. Current production is about 3,500 barrels a day. We have 3 wells offline, so expect that in the coming months to increase. We've got a couple of workovers that are happening, but Murray continues to be a reliable producer of oil. Q's committed to our sustainability. It's too much to go through here, but I encourage you to look at our climate change policy, and we report under TCFD guidelines in our annual report. They're all on our website and will be updated with our annual report in the coming weeks. So this is our pipeline of opportunities in a nutshell. That's between now and the end of FY23. There's at least 12 development wells there that Q will participate in, well recompletions, and an FID for a gas development. This is the growth, sustainable growth that Q has experienced in the last financial year that will continue. And so why Q Energy? I said Again, I would like to maybe put the new Q 2.0. We're a changed company in FY22. 4 geographical production zones, 7 revenue producing projects, all diversified through geography and product. Our results are strong, $44 million. We doubled our revenue in the last financial year and expect that to continue from our existing projects and developments. We're exposed to high demand markets. East Coast Australia gas expected to continue to be high demand. The Amadeus assets are linked into the East Coast. We're exposed to oil through Mari and Mahato, leverage to the high oil prices we expect to continue. And these projects get plus or minus Brent and a premium. And we have near-term growth from our existing assets. 12 plus development wells drilled in the next 11 months. Mahato wells, 1 a month. Current history has 800 and 1,000 barrels a day from the wells. Expecting that to continue, doubles the field production from Mahato, contributing straight to our bottom line revenue. Thank you for your attention. We have a booth out in the area to have a look at some photos and come and have a chat if you're available later on. Thank you, Peter.
Thanks, Mark. Just before you go, Matthew, you've gone through this sort of painful drill bashing exercise in the Amadeus Basin, and you've sort of signaled you're going to draw back and have another think about that whole project. What's the time frame on that?
So we're currently drilling the P1 lateral now into the Pakuta, the Palm Valley producing reservoir. It was announced by Central Petroleum this morning that that's where we're going. So it's weeks now as we go through that lateral.
Yeah, and then the review process is all part of what happens with the result.
Well, that's right, but
Yeah.
this is exploration. Right?
Yeah.
It doesn't always work.
And how does the relationship with Enzog work? You've got them as a substantial major shareholder. What's the future with that relationship?
Well, so New Zealand Oil and Gas owns 50% of Q shares, but we're 2 independent companies. As I like to point out to most people, it's much more favourable to have a major shareholder who has a lot of money than a major shareholder who doesn't. So we work in our favour, and we work side by side, as we showed in the Amadeus Basin investments, where Q and Enzog both independently invested.
Yeah, indeed. I can bring projects to you from Southeast Asia. Okay, well, thank you for coming up today, Matthew. And it's an interesting story. Lots of growth there from Indonesia. So we'll move on to Vintage Energies. Our next speaker is Michael Dodd, who's the Executive of Operations in South Australia-based ASX company. The company was established to acquire, explore and develop energy assets within Australia that will provide gas to the eastern states, and they've been achieving that outcome. So please welcome Michael Dodd.
Okay, thanks for having me. I'm going to continue Matthew's theme of transformation, actually. So firstly, just go through the disclaimer. I might start with a little potted history. We've been presenting at Good Oil since 2018 when we IPO'd. And since then, the Vintage team's been focused on delivering operations in the field and delivering them safely. Since the IPO, we've just moved step by step closer to being a producing company, and we're on the verge of that now. So in 2019, we drilled our first operated exploration well, which was a discovery at the Varley field. 2020, we fracture stimulated and tested that well. 2021, we drilled 2 more appraisal wells on that field, and another exploration well, Odin, which was a success. And then this year we've fracture stimulated Varley 2, Varley 3. We've completed all 3 Varley wells plus the Odin well, and we're now into an infrastructure project to connect that Varley gas to market. So three key features that all that work puts us in an enviable position. It's really about supplying East Coast gas and earning revenue. we're coming up to being a producing company from a few years of exploration and appraisal. We're in a really good position to take advantage of the market dynamics. We've got a 100 PJ reserve. That's gross over the whole joint venture. I should mention our joint venture partners, Bridgeport and Metgasco, have 25% each in this project. So of that 100 PJs, 84% of that is available, is uncontracted at this point, and I don't think you'll find many big swathes of reserves that are uncontracted in Australia at the moment. And we've got proven assets and a proven board and management team to move this forward. So this map shows all our portfolio, but we're going to focus on two mainly: Varley gas and Odin gas, because they're on the verge of bringing revenue into the company now, and then at the Nangwarry carbon dioxide resource, which has also got a pathway to commercialization, and we'll talk about the other exploration assets a little bit later. So in terms of that impending revenue stream, what's Vintage's sales gas position? As I mentioned, we've got that 101 2P PJ reserves at Varley gas. We've got our first gas contract with AGL, and that's to supply between 9 and 16 petajoules in 2 tranches to the end of 2026. The first tranche of that gas is associated with a $15 million prepayment that we've received from AGL. So when we produce gas from that tranche, there's a cash portion and a smaller non-cash portion. That non-cash portion is about repaying the prepayment of the gas. The second tranche, anything that we produce which is above the obligations for the first tranche, we can sell in the second tranche, which is 100% cash payment at market value at the time that the contract was struck. So selling that up to 16 PJs into that AGL contract leaves us with 85 petajoules of uncontracted gas, which is available from Varley. Should also mention that Odin, there, the second discovery, which is, as you see, just to the west of Varley on that map there, has got 36 BCF of contingent resource, and it's not going to take much to turn that into a reserve, given the infrastructure project that's going ahead at the moment. So next, I'm a geologist, so there's got to be a cross section in the presentation. It's the law. This cross section here shows the Varley field and the Odin field. Odin is just 8 kilometers to the west of Varley, and what this is showing us is that we've got gas in multiple horizons. At Varley field, we've got the Patchwarra gas and Tulachi gas, and actually Turrawara gas as well, and some in the Napameri. And at Odin, the 2 main reservoirs again, Patchwarra and Tulachi, but also Epsilon gas as well. In these fields, the Patchwarra does require fracture stimulation, and we fracture stimulated all 3 wells, but the first one we did was Varley 1, and got a sustained rate of 4.3 million a day from that well. The shallower horizons don't actually require fracture stimulation, and we tested the Tulachi and the Epsilon at Odin and got a rate of 6.5 million a day from those. So this is a photograph of the stimulation operations at Varley 2. I'd just like to point out that we've drilled several operated wells now. We've fracture stimulated them all. We've run a completions campaign. We've done the civil works associated with those, all with no LTIs and no environmental incidents. So we're pretty proud of that record. this Farley project now is pretty well advanced. As I say, we've drilled, we've stimulated, we've completed, and now we're onto the infrastructure project. We're through the design and engineering phase, into the procurement, which is almost complete now, and we'll be actually out in the field doing construction in the next few weeks for first gas this year. So just like the cross section, you've got to have a photograph of a flare as well. So this flare is from the Odin well test, where we, as I said, tested the Talachi and the Epsilon at 6.5 million a day. This was the second operated new gas discovery, so 2 from 2 for operated exploration. The location of Odin, just 8 kilometres to the west of Varley, gives us the potential to tie Odin 1 into the Varley infrastructure in a relatively short time frame. The pipeline route which we're using to get Varley gas to market at the Santos Beckler field runs right past Odin, and we've got midline risers as part of the plan there. So we're going through the engineering now of how we could possibly expedite the production from Odin to add to that Varley production. As I mentioned, there's 36 BCF of 2C gas resource at Odin, which is attracting a lot of interest from buyers. A different project which has got potential for to move down the funnel to commercialization also in the near future. This is a discovery at Nangwarry, which is onshore Otway in South Australia. Originally drilled as a natural gas prospect. We did find gas there, but the gas happened to be carbon dioxide rather than methane. So there's a little bit of methane in there. So what we discovered was that, well, actually that's quite a lucrative gas to have in your portfolio. There was a nearby well called the Caroline 1 well in South Australia, which actually only stopped producing a couple of years ago. Produced for 50 years and was actually generated more royalties for the South Australian government than any of the oil or gas wells. So it is potentially quite lucrative, especially here where we've got a good supply of good quality carbon dioxide. So there's a market there in the food and beverage industries, and you wouldn't believe it, but there's quite a global shortage of carbon dioxide for these purposes. So we've got countries actually importing it for those uses. So food and beverage industry, the medical industry, and what's called protective agriculture, which is actually greenhouses, but we're not allowed to say that. So how do we make money from that? We build a plant and produce food grade carbon dioxide for the use of in those industries. So we think about plant sizes, 150 tons a day would be around about 10% of the Australian market. That requires a flow rate of about 3 million scuffs a day. We did test this well, and it flowed at 10.5 million a day. So we've got the rate there. We've also got the volume. So this well could produce for tens of years and be a really good kind of annuity style sale project for us. So we're engaged in talks with infrastructure players around building that plant and looking at various models there for how we go about that producing, and then possibly paying a toll through a plant and selling on the other side, and any other kind of model you might imagine around that. So I've really been talking about those projects in our portfolio, which are the closest ones to providing revenue at this point. This slide just shows how we've rounded out our portfolio with various other exploration permits. We've got one in the Bonaparte Basin, which includes the Cullen well, which Beach Energy drilled, which has some fantastic gas shows in a naturally fractured carbonate, which we would like to test. We can get through the reserved areas issue in the Northern Territory. We've picked up PET 171 with our partners Cooper Energy in Victorian onshore Otway. So with the moratorium off, we're planning seismic in that area. We've also got the Galilee Basin, the huge swathe of acreage there with Comet Ridge, which includes the Albany field, and the Albany 1 well was the first measured gas flow from that basin. And also we've picked up another acreage in another permit in the South Australian Cooper Basin 679, which we're just going through the native title process with. Plus there are other prospects in the ATP to 2021 and PRL 211, which contain the Varley and Odin gas fields. So how do we summarize what FY23 looks like for Vintage? What are the catalysts? So it's really Varley gas into the AGL contract. We go through the construction phase of that, the commissioning phase of that, and appraise the production performance from those wells. We'll move Odin gas closer towards being produced into the market, where we've already started engineering, the concept engineering. So we'll move that into FEED and detailed design, lead that into construction and commissioning. And we're also getting ready to appraise the Odin field and put an Odin 2 well on that field. So I forgot to move on to that slide, but just to sum up at the end here, in case I forgot to mention it, Vintage is about to become a gas producer and a revenue generator. So that's the really important thing for us. But this gas business that we've got is positioned for further growth. We've got our uncontracted Varley gas. We've got a plan to bring the Odin gas to market expeditiously, and we've got exploration and appraisal potential within those same permits. Vintage is fully funded. The Galilee Basin and the Bonaparte Basin as cream on top of that. So it's a really good story for Vintage. We've moved it along close to first revenue, close to first gas production, and watch this space. But thank you very much.
Thank you, Michael. Just before you step down, when you say close, December quarter, all gas
Yes.
flowing, not by the end of September, but
No,
unlikely.
September. We'll be doing the construction during September, but
yeah,
first gas before the end of this year.
okay, good. All right, that's fantastic news, Michael. Thanks for coming to the Goodall again this year, and we'll watch over the next 6 months as the money starts to pile in and you drill another well at Odin, and 15, 20 million cubic feet a day, something like that. Okay, so our next speaker is Bounty Oil and Gas, Kane Marshall, who is an enthusiastic geologist and petroleum engineer with over 2 decades of working experience with independents and juniors. He's presently the Chief Operating Officer at Bounty Oil and Gas, focusing on exploration and development opportunities domestically in Australia. Welcome, Kane.
Thanks. Everyone hear me okay? Good. Good to be here. It's been a while since I've spoken, and terrific time to be talking. We've got conflict in Ukraine. We've got Taiwan, tensions in that area. We've got record drawdowns in inventories. It's almost a perfect storm for oil and gas. and it's part of the future to stay. So, this remote's not working. There we go. Right, so I'm going to start with a question. I don't know whether Martin talked about this earlier. And this is poignant for Australia, it's energy security. Have a guess, what's the number? How many days of strategic reserve does Australia have at the moment? Used to be bad. I think, off the top of my head, a few years ago when I looked at the defence white paper, it was about 21 days. And now I think we've got this Mickey Mouse US thing, which means 68 days. So that's terrific, isn't it? So we're short of 90 days. We've got 21 days in, I think, petrol inventories, 21 days in diesel inventories. And I think by 2030, we're going to be fully reliant on imported crude for our mining and agricultural businesses. And I just think that is unbelievable what's going on. And I think it's a perfect time for companies of the caliber of Bounty and other ones you'll see today and tomorrow to be focused on domestic exploration and development. And we've got very little in the way of refineries now in terms of refining domestic crude. I think there's Inland Oil Refinery and others that go to Port Bonython to Singapore. So that says it all. And I think eventually people are going to have to wake up. I think the Albanese government's open for business and people want to be able to not freeze in the dark and they don't want to starve like what's going on in India. So that sets the scene for us. We're all about focusing on capitalising what's going on in the economy. There's in terms of big drawdowns in inventory, as I discussed, weak Australian dollar, no new investment, a lot of explorations retreated back off the deep water continental shelf. For us, it's really simple. We've got big exposure to offshore assets, offshore Sydney Basin. I think David Breeze talked about that. It's got plenty of media attention recently. Offshore Carnarvon Basin. And then simply our development assets in Queensland, we could focus on developing those through operatorship. We've got new opportunities we continue to assess, midstream particularly, if you look at what's going on, monopolies on gas pipelines in this country and lack of new refining capacity. And we've got excellent array of near field opportunities and lower risk opportunities. So from a risk perspective in the portfolio, low cornerstone by production and looking to grow in the face of some of those themes I've just discussed. Well, everyone's here today to know what you're doing and why should we buy a stock. So Bounty, nimble, ready to move. We've got positions in 3 basins in Australia. We've got the best code on the ASX to buy stock, BUY, buy.